Good morning, everyone. Welcome to Windsor Brokers live daily market outlook for Tuesday, 18th of September 2012. As you can see, we have changed a bit of our design, so we are improving things on a daily basis. Also, you can see on the page there is an email, so you can contact me or anyone from our team. You can send an email, your suggestions, comments, feedback, anything you think could be changed or could be added. It will be of great help for us because we designed this first for you and then for the others. As the day progresses, the Europe is opening. We can see that the dollar is in a sort of recovery after strong losses have been recorded during the past week, with the single currency slightly at the back foot, consolidating the recent strong gains. The top performer yesterday was crude oil, as in 4 minutes of quite hectic high volume trading. The oil price dipped approximately $4 from on the late Monday's trading, and they basically left traders and the U.S. regulators hunting for the cause of one of the fastest and most furious energy market routes in the recent years. In the absence of any major headline news that could have explained the drop, which hit both international benchmark Brent crude as well as U.S. crude oil futures, traders and analysts speculated it might have been caused by an incorrectly entered trade or fat finger error or a high-frequency computer trading program mistake. The White House said there was market speculation that it was ready to approve an oil release from the U.S. Strategic Petroleum Reserve to bring down prices, although it said the option remains on the table. I recall we mentioned this in approximately 2 weeks ago when this subject came on the table, as U.S. officials said that they are undusting this plan, but later on they denied any plans of releasing the strategic oil reserves. As oil said, the top performer yesterday, dipping from the recent high at 140 on Friday, with yesterday's dip from 99.48 down to 94.67. As said, the euro is still in the slightly defensive near-term mode, but still holding high levels, as yesterday's fresh strength posted marginally higher high at 131.70, while sterling is still holding a positive tone currently at 162.40, just off recent high at 162.72 and off our near-term target at 163.00, with the dollar yen gaining speed. 78.92 high yesterday seemed just ahead of important 79 zone barrier, with some corrective action so far being contained at levels of 78.50. Dollar Swiss remains under pressure, though sideways trading is still active, moving within 30-40 pips range of its recent low at 92.37 posted last Friday. Gold also ticked lower in a corrective action of recent peak at 1777.70, with the 1752 low seen so far, with a rather negative near-term tone, seeing potential for possibly more extension, a stronger extension lower. From today's calendar, that is a bit bigger than yesterday's one. As we said, progressing into the week, we are getting more economic releases. The Swiss consumer climate has already been released, and government cuts are basically its 2012. It cuts its growth forecast for 2012, saying signs of a worldwide economic slowdown had intensified, but said Switzerland would escape a market recession due to stable domestic demand and the central bank's currency cap. Speculation of increasing the cap of the Swiss franc basically pushed yesterday the Euro Swiss to the fresh highs, hitting 121.82, but this seems to be this proved to be false news, as the pair again dips lower, currently at 121.30, following initial positive sentiment and a rally to 121.80. From the other countries, releases start with UK at 8:30 GMT with the inflation for August seen slightly lower, expected at 2.5% compared to 2.6 in July. A home price index for July is expected to increase to 2.8 compared to 2.3 in the month of June, while August retail price index is forecasted slightly lower from 3.2% in July. Today's forecast is 3%. Follows the Eurozone and German zoo economic sentiment at 9 o'clock GMT. European one, it's for September. European one is both are basically seen as improving in the month of September with still negative readings. Of course, European is forecasted at minus 16.3 compared to minus 21.2 in August, while also improvements seen in Germany, minus 19.7 compared to minus 25.5 in the month of August. These are quite important releases, and most of the day focuses on these releases along with the UK's inflation. From America's second quarter current account is due at 12:30 GMT, slightly narrowing the gap to 1.126 billion US dollars compared to gap of first quarter at 137 billion US dollar. At 1300, this long-term purchases for July 45.3. Great improvement from 9.3 billion US dollars in the month of June, and housing market index at 1400 for September, 1400 GMT for September, expects no changes at 37. The current account from New Zealand comes at 22.45. That will be, according to our local time, already the new day, widening up to minus 1.62 billion New Zealand dollars compared to gap of first quarter at minus 1.31 billion dollars. And that's all from today's events. We have to take our focus to UK and especially Eurozone and Germany releases in the morning hours, and of course the America's current account in the afternoon. And we're going to take a look. I would like to start with crude oil. As we said, it's the top performer of yesterday. We can see the sharp dip from yesterday's high at 99.48, dip down to 94.67. I think it's a better scene. Basically, the oil price has erased nearly fully erased, I do apologize, the latest rally from 7th of September, higher base at 94.09 as it progressed through range top at 97.30, 97.60, and then 98.27 previous high, breaking also important $100 barrier to 100.14 on last Friday, and a recent dip now has turned the short-term outlook into the negative territory again, with the focus more towards the downside despite yesterday's strong bounce higher from the spike lows at 94.67. Upside is so far being capped at levels 97, above just 97, with the 55 days exponential moving average, with the price currently approaching 96 as round figure support, seeing more potential towards the downside as 4-hour studies are entering the negative territory, and the quite negative outlook seen on the hourly chart, seeing more potential towards the downside. As set 96.00 the first focus, and then comes from static supports and 95.36, and yesterday's spike lows 94.88 and 94.67 ahead of important base, higher base at 94.00 zone. These are the levels here as the price dips again below 200 days moving average, and so far holding below. We'll be looking for today's close of the oil market and see if, in case of closing below the 200 days moving average, then we might see some more negative impact on the yesterday's sharp sell-off, possibly test of 94 base, loss of which would be quite bearish for the oil price, as this would be signaling probably further retracement and possibly to open 38.2% retracement at 91.56, also low of 10th of August 2012 at 91.70. Before this, we have the previous high as good support at 93.22. As said, near-term tone remains negative, though the daily studies are still in the positive territory, slightly turned towards the downside. See at the moment in the near term, see potential for a further extension lower. I think we have a small problem with okay, now it appeared. Seeing is more potential towards the downside in the near-term trading. Back to the currencies, or since we are in the commodities, I think we can take a look on the yellow metal also, which is also in the descending mode of 1777 recent peak, measuring over between 38 and 50% retracement of the latest up leg from 1770 spike low of 13th of September up to 1777.75 peak of 14th of September. Past week, one-day rally was quite strong, with the negative tone now dominating in the lower time frames, as hourly 20 days exponential moving average crosses below the 55 days. So one putting additional pressure at the pair, with studies indicators being in the negative territory, seeing more potential towards the downside for further retracement. Break below the recent low at 1751.95 posted this morning sees 1747, 50%, and 17 equivalent also to the previous peak, as peak of 12th of September 2012. Below this we have another good support at 1740, 61.8% Fibonacci retracement, and that will be quite risky for the pair, as break below 1740 will bring 1720 and the 1720 zone. This is the spike low of 1770 and the previous higher platform that might weaken the near-term structure. I think it's shown better on this 4-hour chart. 1737 also we have the 55 days exponential moving average. As said, currently more focusing towards the downside in the near term, and as corrective action of a recent strong rally seeks for a further reversal. I would say the immediate risk would be seen on loss of 1750, 1747 support as the previous high. That might allow for a stronger reversal, and the next significant support lies at 1720 zone. And we start now with the euro, with the currencies. With euro, as said, the pair is in the near-term defensive mode following a renewed attempt higher that failed at 31.70, posting just a few ticks marginally higher high from against the 131.67, with formation of doji star-like pattern on the daily chart, seeing risk of stronger reversal, as the pair remains in the stronger 2 weeks rally from 125.00, and some corrective action, as daily studies also entered the overbought territory. Some corrective action cannot be ruled out at this point. On the hourly chart, the indicators broke below their center lines, seeing potential for further extension lower, although the base at 130.82 so far holds. Dips reinforced by hourly 55 days exponential moving average, and this will be seen as a first trigger, along with the 130 the linear regression channel top at bottom, pardon, at 130.50 zone. That will be initial support, and in case of break lower, then we might be facing the stronger corrective action. On the 4-hour chart, this is on the 4-hour chart, 130.10 is 23.6% retracement of the larger up move from 125.00, while another good support stands at 129 zone, where it's approximately 38.2% retracement. A previous high at 129.35, and the for our 55 days moving average at 128.92, and basically break below initial 130, and then another significant 129 would be a signal for sidelining the current bulls in favor of a stronger corrective action. On the hourly, we can take a look of the latest up leg from 128.54 to 131.70. Immediate support, as said, is 38.2% to 130.50, minor previous high of intraday high of last Friday, as well as channel support. Ideally, any reversal should occur at or above 130, 130.50 zone. Otherwise, we see risk of deeper reversal, as loss of initial strong support at 130.00 would open way for a stronger reversal. In any case, reversal set above 130 or 130.50, which is quite unlikely at this point, as the pair starts to extend lower, would keep the focus on the upside with break above 131.70 to open 132.00 as our next upside target. On the downside, loss of 130.00 and another Fibonacci at 61.8 at 121.75 would be a good signal of double top formation, double top pattern formation on the hourly chart, and this could be quite a good bearish signal for the pair. The cable is still holding the positive tone following yesterday's fresh marginally fresh high at 162.72 against 162.55 last Friday's one, with the base at 162 zone still holding, reinforced by 55 days exponential moving average. Descending studies in the hourly chart and the 4-hour indicators now starting to point lower out of the overbought territory are good signal for possible corrective action, stronger corrective action of the recent strong rally from 30th of August, higher low at 157.69 that progressed so far to 162.72, and just ahead of our main target and the key medium-term resistance, 30th of April 2012 swing high at 163.00. That acts as our next upside target, as bulls remain firmly in play with no signal generated, reversal signal generated yet on the larger time frames. Still seeing room for possibly stretch towards 163.00, but said overextended lower time frames studies now see more potential for the corrective action. Immediate supports of the latest upleg from 60.74 to 162.72 Fibonacci levels. As said, we have the base, higher base at 162.09, ahead of 161.96, 38.2% Fibonacci retracement. Basically, 162 zone is seen as our initial and quite good support, ahead of 161.50 that marks a 61.8% retracement, and basically break here would be a signal for some stronger corrective action, as 161 break below 161.50 will open 161.00 and 160.80. There is a 38.2% retracement of the larger upleg from 157.69 to 162.36, reinforced by 55 days exponential moving average at currently at 160.89. And basically, if we see any reverse, any deeper dips, should ideally find a reversal somewhere around 161 in order to keep, according to the previous movements, there was no more significant corrective action. So ideally, somewhere above 161, the support should be found in case of any deeper dips. As I said, on the larger picture, there is still room for a stretch towards 163, our initial target. As mentioned at the beginning, the dollar yen is in a strong rally of its recent spike low at 77.12 posted last Thursday, as the gains progressed up to 78.92, just ahead of strongest 79.00 barrier, retracing over 61.8% of the initial down move from 79.65. A positive tone continues to dominate on the lower time frames, although corrective action of 78.92 yesterday's high found a footstep so far at 78.50 that looks quite supportive for now, as this marks also 23.6% Fibonacci retracement, although the potential, although they break above 78.92 and 79.00 is required to confirm the current near-term positive tone and open way for a further extension higher. As said, we have quite strong barriers at 79.00 is the previous highs at 79.01, 79.03. It's also round figure resistance, and daily Ichimoku cloud top currently at 79.13, break above which would be good signal for further extension higher, although for now the price is still struggling to penetrate the cloud again following yesterday's move in and move out down to 78.48 where the support was found. We need to see the penetration through 79.13 in order to confirm positive, near-term positive stance of the pair, and the open way towards 79.65, high of 20th of August, to confirm the bottom at 77.12, and basically regain of 79, lift above 79 would confirm the bottom at 77.12 and prevent the pair from further slide. And finally, dollar Swiss still in the sideways narrow range consolidative mode of recent low at 92.37 posted last Friday, with upside still being capped at below 93.00 as initial resistance and round figure resistance, as currently at 92.88, descending 55 days hourly moving average keeps the upside limited. At this point, not much to be expected from the recovery, although the 4-hour studies started to point higher as they are deeply overextended with the pardon, break above 93.00 seen requiring a regain of minimum 93.40, which is the low of 12th of September, and approximately 93.60.70, that is 38.2% retracement of the down move from 95.78 to 92.37 in order to ease the current bear pressure and allow for some stronger recovery, and quite negative tone still dominating on the larger time frames with no signals, firm signals of reversal, seeing more potential towards the downside with the break below 92.37 to open at 92.00 and then 91.80 our next downside targets as a part of larger downtrend of dollar Swiss from 99.70 peak of 24th of July 2012. That was all from me. Please, if you have any questions, you can submit them down if there is anything that we missed to cover. Also, again, to mention that all these analysis, including the commodities and the crosses, you can find in written in our if you are a client of Windsor, you can find them in your trading platform. Otherwise, you can find them in a number of financial sites. One of them is fxstreet.com. Briefly, we have the Aussie dollar question. It's been some days to take a look at the Aussie. Basically, it's in a strong defensive mode, better seen on the 4-hour chart, following a recent break above our previous top at 106.12. A brief break, basically higher at 106.23 was all seen, and now the pair is descending lower, with over 38.2% being retraced and testing currently the previous lows and the higher platform at 104.28, also reinforced by 55 days exponential moving average with studies on the 4-hour chart, indicators pointing lower, seeing more potential towards the downside with the break below 104.28 to open 104 as the next important support. This is the previous peak, also around 50% retracement of the move from 101.65 65 to 106.23, with the daily structure is still being also in the negative territory. I would say at this point a more bearish outlook, more bearish tone seen for Aussie dollar, as break below 104.28 is expected to open immediate support at 104.00, and then Fibonacci support 61.8% at 103.40, along with the higher low at 103.22, loss of which would confirm the top double top basically on at 106.12.23, and look for further extension lower as loss of critical support at 101.65 would be a signal for a quite stronger bearish action. Okay, we're a bit out of range at this point, but important to mention 103.26 is the 200 days moving average. It's approximately close to 61.8% retracement, and loss of this level would be quite bearish for the short-term action of Aussie dollar. Do we have any further questions, or we can conclude today's session? It seems no. Okay. In that case, I would like to thank you all for attending our live sessions. You can find the recorded version of this in the YouTube. Our page is called Windsor Brokers Forex. We're back tomorrow morning at the same time at 7:00 GMT. And until then, I wish you a nice day and, of course, a very good, profitable and successful trading. Good luck.